there will be more blood in the oil and gas industry in shale soon. So I've been warning about this for about a year now, since really November 2018 when oil prices were at 70, and the amount of oil being produced from shale oil and gas, it was being produced very inefficiently. I could tell how much waste, fraud, corruption, and abuse. And then as oil prices kept falling, the shale producers did not cut back oil production. In fact, counterintuitively, and probably because there's so much debt level, there's hedges and a lot of debt in the industry used to grow production, and that's why there's record production. Despite oil prices going back down, oil production grew. So here we are at record amounts of U.S. oil production, a lot of it from shale, the growth especially out of the Permian. And this past week, there was a number of key stories. So one of the main companies in the shale oil and gas boom, Chesapeake Energy Corporation, and Bethany McLean covers this in her book, Saudi America. I highly recommend reading the book. The book is only about 3 or 4 hours on audiobook. It's a pretty quick read. A lot of interesting details there. She's one of the best financial investigative journalists living right now. She's out at the very top of her game. And she spends a good amount of the book talking about the history of Chesapeake Energy and Aubrey McClendon early in the book. And now Chesapeake Energy is a natural gas producer. However, at the height of its capital raising ability before natural gas prices crashed, Chesapeake Energy had a $37.5 billion with a B dollar market cap. So Aubrey McClendon he was considered one of the best salespeople of any CEOs. People on Wall Street respected and feared him because of how easy it was for him to raise capital for a very long period of time. And this past week on Tuesday, Chesapeake Energy Corp disclosed that they received a quote-unquote going concern from their auditors. And if you guys are not familiar with what that means, normally the company that's doing the auditing, the accounting firm, normally it's one of the big four accounting firms who are doing the auditing for the publicly traded accounting statements, Sarbanes-Oxley, etc. Normally, they do not want to issue a going concern. So the people inside the company are going to be fighting it. Once the going concern is issued, that basically means that if bankruptcy is not happening this week, it's imminent. So bankruptcy is very close to imminent, and the insiders at Chesapeake Energy Corp, they tried to, I would say, this is just my opinion, not financial advice, I would say the insiders at Chesapeake Energy Corp, the new CEO and the executives, they tried to trick and fool people. It was a trap. They tried to do a ton of insider share purchases to tell people that they're not going to go bankrupt. But natural gas prices have not rallied. They've been in a bear market. There's an oversupply of them. There's been a ton of natural gas production produced very inefficiently. The same for shale oil, although shale oil the price of oil has not collapsed to the levels that natural gas has. And, I've been talking about this, documenting this for at least a year now. Even when oil prices rose, I was cautioning people, and the analysts out there were saying, oh, now that when oil last year was at 70, that oil was going to 100. I was like, the global economic data did not support this. The global economy was getting much worse. I was covering the global macro data. And then I was seeing that even as oil prices, like I said, started to fall, the oil production was not cut. Now we are seeing a few signs this week that long term, the oil market in the US may be getting close to a bottom with rig count, but in the short term that doesn't matter, rig count being cut, because the other major story besides Chesapeake, and I have a number of articles about Chesapeake if you want to read more in depth about it. The stock right now for Chesapeake, which is CHK, Chris Harry Krispy Kreme, is below $1. It's at 90 cents right now, but really it got as high as I think like 60 something. It got to about, let's see here, according to the chart, $62.40 on June 1st, 2008. So Aubrey McClendon was a brilliant capital raiser. He was, overpaying for land. He was putting enormous amounts of royalties into his pocket. He had an oil hedge fund. It talks about this, a lot of his excess, if you want to read about it. He was brilliant at raising capital and not good at being efficient with using capital. And the last year or so, the stock went from like $3. Last year, a year ago, it was $3.58 a share. And they just received this past week a going concern warning from their auditors. So the management team, I'm sure the management team at Chesapeake was trying to fight this, what the auditors were saying, because the auditors, like I said, the big four accounting firms do not want to issue a going concern because that means they're going to lose business. Okay, if Chesapeake goes bankrupt and the assets get bought by ExxonMobil or one of the larger oil and gas companies, that's one less firm that the big four accounting firms can charge. But that's most likely what's going to happen. I wouldn't touch these shares. The balance sheet is just a disaster, and they've used capital way inefficiently, and their assets, I think, a lot of them are overvalued. But their market cap has gone from $37.5 billion at the height down to, I think it's right around $1 billion right now. So it's a really sad story. We're also seeing a lot of oil and natural gas companies announce over the last 12 months that there's big Capex cuts. And I've talked about the importance of Capex for mining companies, oil and gas factories. Capex normally means it's either, if it's maintenance Capex, it's the cost to maintain the revenues or maintain the property, plant, and equipment. It's a necessary cost to maintain the business, so it generates revenues. But the investment for oil and gas, it is very, very important for the growth Capex. So Chris Mortensen has talked about this as well. There's been basically cuts to the bone in a lot of growth Capex. So investments into finding new oil discoveries, it's been slashed to the bone. The last 10 years, the global economy has been very, very reliant on shale oil to grow production, and I would argue very, very inefficiently subsidizing oil production, inefficiently not growing with free cash flow with the oil production, even though the costs of the shale production have fallen, and that's what's kept some of these shale companies from going business right away. But my thesis is that there's going to be more blood, most likely less than 3 years, probably less than 2 years, maybe even the next 12 months, unless we get substantially higher oil prices that stay there. The problem is if oil prices go back to $80, $90, $100 a barrel and stay there for a while, it's going to act as a tax on the global economy. It's going to be as if the Fed and other central banks raised interest rates to 3, 4, 5, 6%. So if the Fed did that, that would, number one, that would crash the corporate bond market. That would stop the share buybacks. That would cause the U.S. federal budget deficit would blow out on interest payments on the debt. They wouldn't be able to raise as much debt, charging a higher interest rate because they couldn't pay it. And the oil companies with a higher oil price, the oil companies would be able to make more money and make investments into finding more oil. However, the global economy can't really afford that. So the other major higher oil price, especially with all the stories and data points we're hearing about the global macro data. So unfortunately, that means I think more and more job cuts. There's another article that just came out from Axios this week about how it's going to cause a lot of job cuts in New Mexico and parts of Texas. You can read that if you want. The article's from Orion Rumler from November 4th. I'll put that link in the information and description section. The other major story about the oil market, and like I said, the rig count is falling. So that is good long term for the U.S. oil market, for the global oil market, because if the rig count is falling, that means eventually there will be production cuts probably. However, in the short term, it doesn't matter that much. And in the short term, we also still have, and the data came out on Wednesday, we also still have massive inventory builds in the U.S., oil inventory builds. So the Energy Information Agency, which is a segment of the Department of Energy here in the United States, and one of the best free resources, probably the best free resources if you want to do research on the oil market, is on oilprice.com. There's tons of great articles. They track a number of the different oil prices. They have an app with articles. They have an app that you can download for free. Carl Icahn, it says here, just dumped his oil position. He's getting worried in Occidental Petroleum. So a lot of people are really starting to worry now about the oil industry, probably based on the Chesapeake news. I believe Occidental has pretty heavy investments in shale as well. The deep water I've covered. That's higher cost oil. Deep water is not going to do well in this environment where when we're recording this right now, oil prices, WTI still below 60 at $57.18 and Brent crude's at $62.44. So over the last month or so, we've had a little bit of a rally in oil because remember, WTI was in the low 50s and it briefly, I think, dipped below 50. But even at these prices, a little bit of a jump in oil. The oil companies, out of desperation, they have not cut their oil production. They've actually tried to keep increasing their oil production, especially in the shale patch. So the amount of crude inventory builds, let me talk about this article from Irina Slav. She's a oil industry journalist. There's a number of really, really good oil industry journalists who write for oilprice.com, like Nick Cunningham, who I follow his work a lot, Julianne Geiger. There's really good quality writing over on oil price, and it's free. Crude oil prices, this is her article, 30 million barrels added to oil inventories in only 7 weeks. Crude oil prices declined again on Wednesday morning after the Energy Information Administration reported a crude oil build of 7.9 million barrels for the week to November 1st. Analysts had only expected a much more modest build of 1.515 million barrels for the period. So analysts were only expecting a 1.515 million barrel oil inventory build and instead got almost an 8 million oil inventory build. What that tells me is that even though oil prices are still down and they're going sideways with volatility, that the oil companies are trying to produce as much oil as possible because they need that revenue. Normally it's for either hedges, they've hedged the oil at a higher price, or some of these firms have that, or it's because these companies have so much debt on their balance sheets that they have to have any and all revenue, every last penny of revenue coming in to handle the debt loads that and it's so dangerous for oil companies to be drilling on debt because revenues can fluctuate so much. Oil prices are so volatile. It's very unpredictable. If you look at the predictions for oil prices from CEOs of oil companies, they're almost always wrong. 6 months, a year out, almost always wrong. So the fluctuation in revenues is dangerous because if you have a lot of debt on the balance sheet and you thought you were going to have a certain amount of revenue and then all of a sudden your revenue is cut by 50% or more, you're still stuck with that debt. And if you have a lot of debt, the interest payments on the debt are high. Forget about even paying the principal off. The interest payments are high. So that's the problem these shale oil companies are running into. So I don't know if we're going to see... Chesapeake so far is the largest oil company, and Chesapeake's on death row. So I don't know if Chesapeake's going to go bankrupt this week, next week, the week after. I don't know if anyone knows that for sure. But they're on death row. Okay, so they have the handcuffs. They're being walked by the marshals into the gas chamber, or they're getting strapped in with the needle on. So it's only a matter of time now for Chesapeake. No one wants to touch that balance sheet. If a large oil company acquiring, no one wants to take on all that risk with the debt. They do have some good assets long term. They do have some good assets long term, but okay, so back to, but I think, ExxonMobil or one of these other larger oil companies is going to go into bankruptcy court and they're going to be able to buy those assets for pennies on the dollar. I don't know if it'll be ExxonMobil. Maybe it'll be Chevron. Chevron has a better balance sheet, in my opinion, than ExxonMobil right now. So this latest build adds a string of 6 weekly inventory increases over the last 7 weeks with just 1 weekly decline. The string has added more than 30 million barrels of oil inventory, with the one single decline only taking 1.7 million barrels out of the accumulation. A day earlier, the American Petroleum Institute estimated U.S. crude oil inventories had added 4.26 million barrels, which, although without an immediate effect on prices, contributed to a deteriorating sentiment after OPEC warned that oil demand is weakening globally. The cartel warned, so demand is also, OPEC's also worried that demand is weakening globally. And I think I also saw a story that OPEC is actually increasing oil output again. So this story came out a couple days ago from Svetoslava Perskova, also on oil price. OPEC's crude oil production jumped by 1.26 million barrels per day from a decade low in September to 29.71 million barrels per day in October, as Saudi Arabia restored its production to levels before the attacks on its oil facilities. So OPEC, and I've talked about this many, many times in the past on oil podcasts, OPEC, you would think rationally that OPEC would cut production when oil prices are low so they can move oil prices up. But if you studied what OPEC does when oil prices go low, that's not what happens. So normally when OPEC, when prices go down a lot to $50, $40, even $30, some of these OPEC countries, so much of their government, their tax revenues, their government budgets are balanced with oil production, that these oil producing countries, some of these countries have 90% of their government budget is funded with oil. So oil is very important to fund these governments. So they don't cut oil production. They actually maintain or increase oil production levels when oil prices fall. So it's very counterintuitive. You only know this if you study the oil market a lot. Like I've disclosed in the past, my day job for a year was an oil analyst. So I worked with one of the best oil analysts out there, Robert Rapier, for a full year. He's worked in the oil and gas industry for, I think it's around 30 years now for his day jobs. He's worked at a bunch of different companies, ConocoPhillips and others, and he's also written paid investing newsletters. He's one of the smartest oil analysts. I've interviewed him a lot in my archives on the podcast. I've interviewed him a lot over the years. So bottom line is the oil industry, the misallocations of capital is starting to finally weed itself out. So Chesapeake Energy was one of the most wasteful companies. They might be the most wasteful company, but they were enormously wasteful. Now, there is smaller private shale oil companies that are well-run, that are profitable, but the publicly traded shale oil companies, from what I've heard from my industry contacts and looking at the financial statements and reading articles from financial journalists and in Bethany McLean's book and talking with hedge fund managers who trade oil, that the publicly traded shale oil companies were extremely inefficient with the capital they raised. And they raised over $1 trillion in capital. At one point, it was many billions of dollars per year. It was like over $100 billion per year that they were raising since 2007. Okay, so we have a super chat question here. I have a bunch of other articles if you want to read more on this. So the rig count dropping is good long-term for oil prices, but in the short term, the shale oil companies are running at the red line. They're maxing out to try to save themselves with oil production. And that's why you're seeing the inventory levels rise. I think the government agencies that are making guesses about oil inventory levels, they're not looking at the balance sheets of the shale companies, and that's why they're wrong in their estimates. In my opinion, that's why they're wrong in their estimates. Okay, we got one super chat question coming in from Tarkinas again. Thank you very much. Hedgeye issued a buy on oil. What's my take? So I think Hedgeye, in my opinion, is using futures contracts. And with patience, they could probably get a pop in oil prices with the rig count going down. Now, if the rig counts... It depends if the rig count keeps going down. So if you keep seeing declines in the rig count, then yes, it's more likely that there will be bottoming in the market. But there's a lot of pain in the oil market, in my opinion, still coming with the oil service companies, with a lot of these natural gas producers who are unhedged, and with these shale oil producers who are either unhedged or they have way too much debt on their balance sheets. So the most pain is going to come not from the oil price. The oil price might not go much lower, but the pain is going to come from the producers, because the producers gambled on higher oil, and the oil producers did, and they lost. You cannot drill on this much debt and still raise production, even when the oil price was declining. The balance sheets are a mess for a lot of these publicly traded shale oil producers. And I do not think that the Chevrons of the world, the ExxonMobils, the Royal Dutch Shells are going to come in and do bailouts and drastically overpay for these assets like what ExxonMobil did to XTO Energy. I think ExxonMobil paid $40 billion for XTO Energy, and I don't think their acquisition ended up being worth anywhere near that. This acquisition was, 2010? If they would have waited, I think they would have gotten that acquisition for less than half price. Another mistake, large mistake, with capital allocation with ExxonMobil with the XTO acquisition, and then also all the share buybacks with debt that Rex Tillerson did. He was buying, when he was CEO, Rex Tillerson was doing many billions of dollars in share buybacks when ExxonMobil stock was like $90 per share, $80 per share, and the ExxonMobil stock is nowhere near there. So I think Hedgeye, as you can play oil, Tarkinis, without having exposure to the oil producers. That's my opinion. The oil producers, especially the ones who have the most shale exposure and the worst balance sheets, there's a lot more pain coming. Now, there is a couple good companies like EOG Resources, but I would not be long that stock now. I'm not long that stock now. So just my opinion, not financial advice. I'm not long EOG, but I think EOG has been doing a really good job, management has, about cleaning up the balance sheet, getting rid of the debt, focusing on making free cash flow. Their free cash flow has been getting improved the last like 6 or 7 months from when I've been looking at their presentations. So I think Hedgeye, my opinion, Hedgeye is going long oil futures contracts, and they can be patient with that, but oil producers, especially ones with a lot of exposure to shale, there's a lot more pain coming. So the shale gas companies are in a lot of pain, and the shale oil companies are in a lot of pain, and it's going to get worse. But the big Capex cuts means loss of jobs, unfortunately, coming. And I've documented this for months now, that was really one of the largest sources of job increases since the 2008 financial crisis, was job increases in North Dakota, Texas, and other Oklahoma and other shale areas. Meanwhile, we have the ExxonMobil CEO that's telling everyone in public comments at industries and on conference calls that they're going to get double-digit returns on their Permian and shale oil investments, when almost no one else in the industry is getting that. Kyle says Halcon Resources went Chapter 11. Yes, and Chesapeake Energy was the largest company that has gone bankrupt so far. At one point, their market cap was $37.5 billion. Now it's only around $1 billion. Market cap, according to Yahoo Finance, $1.022 billion. Management team at Chesapeake trying to fool investors with a value trap. A lot of insider buying in shares lately. This week, trying to fool investors. This would be one of those cases where, in my opinion, where insider buying is a false positive, a false signal. The going concern, when the auditor, first of all, if the auditor doesn't want to issue a going concern, but if the auditor issues a going concern, things are that bad. Going concern means bankruptcy is imminent. So it might not be today, might not be tomorrow, might be not this week or next week, but it's imminent. The decline rates on the Eagle Ford Shale are also a lot too. So the wells had good production for about 2 or 3 years, and then they've collapsed. Yeah, you like my There Will Be Blood reference? I thought that was good. With the Daniel Day-Lewis, the 2007 movie about the oil patch. Looter92 says tar sands are worse. The tar sands might be worse, but only because they weren't subsidized by pension funds and Wall Street banks. The shale oil companies have received over $1 trillion in capital they should not have raised. I really hope we do not start a war with Iran. Trump also talked about seizing the Syrian oil fields recently. So that might move oil prices up, but even if oil prices pop a little higher, it's not going to be enough to save a lot of these shale companies. Their balance sheets are that bad. They don't have free cash flow. There's very few companies, publicly traded ones, that have free cash flow. And this is the problem with debt. Because as an oil company, you're in a very capital intensive where you need a lot of maintenance capex, very cyclical, and your revenues, the volatility in oil price, your revenues could fluctuate very, very violently. So you could be planning capital allocation, how much growth capex, how much investment. Growth capex is investment. It's different than maintenance capex. I talked about this on a mining stock education lecture. There's articles that I have under that lecture about this. So all of a sudden, as an oil company executive, you're planning to make a lot of hundreds of, billions of dollars of investment into growing your oil production, oil exploration, etc. And then all of a sudden, the oil prices drop a lot in 6 months or a year, and you have to cancel all the plans. So I would watch for the oil inventories to stop the build, but I don't think that's likely in the short term because, like I said, in my opinion, the shale oil companies will keep maxing out as much oil production as they can to try to save themselves. That's why they're not cutting oil production. But the rig count going down, the oil service companies are even in trouble. If you look at the share prices of Schlumberger and others, I was warning people about this a year ago. I was talking about the shale oil producers, the oil service companies. When oil prices go this low, the oil service companies and the drillers like Schlumberger that drill these shale oil wells, these tight oil wells and natural gas wells, they have to discount heavily what they charge to drill. So that means their margins go out the window. This is a really good super chat question by Veritas Arrow. Do I think they'll get a bailout too if they fail? The shale oil companies already received a bailout. I've talked about this a while now, for years. There was an article, I think in 2014 or 15, Zero Hedge reported on it. The Dallas Federal Reserve denied it. But Zero Hedge then added more information from their source. And I believe not only Zero Hedge had multiple sources on this. You can go back and look it up. But Zero Hedge reported on this in the last, I think it was 2015, that the Dallas Federal Reserve told the Midwestern banks in Texas and the Midwest to not call in shale loans. This was years ago. So I think there was already a bailout back then. And yes, they could. And I've talked about this. Rule number one is the governments will change the rules. They could change the rules. But if Chesapeake's going bankrupt, and Chesapeake was one of the largest natural gas, shale gas producers, if they're going to allow Chesapeake to go bankrupt, then they'll allow almost anyone to go bankrupt. So they could do rules changes, they could delay things more, but are they going to bail out all the shale producers? Well, maybe what'll happen then is they'll allow bankruptcy for the shale producers, and then the Wall Street banks will float some extra money so Chevron can come in and buy the assets for literally pennies, and then get them back up and running very quickly. I could see that. But I would not be long any of the, this is just my opinion, I would not be long any of the equities in natural shale gas and shale oil producers right now. Especially the ones with the most debt on their balance sheets. Now, you may get a rally in the short term, but if they're going to keep increasing production and the global economy is going to be getting worse, there's so many headwinds for the oil price right now. And if a larger oil company does buy the assets, I don't think they'll sell at premiums. And the assets could be purchased out of bankruptcy court, which would wipe out the current equity shareholders. Yeah, Greg says WTI price, I talked about this earlier, is around $57 a barrel. The production cost I had on Art Berman a couple months ago. And the production cost for a lot of these shale companies, other than EOG, the publicly traded ones, other than EOG Resources, their costs are still between $60 and $65 a barrel. Vincian Magtao, I don't know which state you live in. There's a lot of taxes layered on to the price of gasoline. There's a lot of taxes layered on, and in states like California, there was a research report from the Tax Foundation in the last 5 or 6 years that the state of California actually makes more money per gallon of gasoline because of all the taxes that are layered on than any of the oil companies. Amaro Amigo asks this, how do you profit by the demise of Shale? Well, just my opinion, I wrote a research report on this a year ago that the oil service companies and the shale producers, I wrote a research report for a client who paid me to do a lot of research on this and then didn't listen to anything I said, that the shale oil companies were good shorts a year ago. That the oil service companies were good shorts a year ago. I haven't looked at the charts lately of all of these ones, but they were looking really bad a year ago. Because oil prices were back to 70 and the charts were looking weak, and I was looking at the global macro data and the financial statements of these companies, and it was not looking good. So this was predictable. You can go back into the archives, and I talked about this a year ago, warning about the oil industry. We'll see what rules changes there are from the powers that be with the Federal Reserve. I'll try to find the Dallas Fed article. You can just look up Zero Hedge Dallas Fed Shale bankruptcies. You could just search that and you should be able to find the article. I think it's from 2014 or 2015. Yeah, so we'll see what happens with the shale companies, but it's not looking good. The only thing that looks good is the rig count dropping, but that's bad for jobs in those areas. If the rig count keeps falling here in the US, that will be a good sign that oil prices will not go much lower. But the shale producers, the shale oil producers, are maxing out everything they can to delay bankruptcy, to pay back interest on the debt. A lot of these shale producers, publicly traded ones, have little or no hope paying back the total size of the debt. They can only make the interest payments now. So I have a bunch of other articles about the oil industry, the stuff that's going on there if you want to read it, but I just summarized it for you. The tar sands are worse in the sense, Looter, that they're not, number one, that oil always sells at a discount. The tar sands bitumen always sells at a discount. Number two, it has to be piped down here to the US, and you have the environmentalists fighting a lot of the pipelines. And number three, they didn't get the capital that the shale oil companies did. So there wasn't as much waste, fraud, corruption, and abuse with the tar sands companies, but all the extra capital that the publicly traded shale gas and shale oil companies raised, that's delayed bankruptcies in a lot of them. And the global economy really needed all that shale oil production. Without the shale oil production being subsidized by the pension funds here in the US, the Wall Street banks, the global economy would have probably already collapsed a lot sooner. Oil prices would have went higher. Oil prices over $100 without shale oil. And then oil prices would have acted as a tax on the global economy and collapsed it sooner after 2008. Like if oil prices would have went to 120 or 130 a barrel again, it would have probably collapsed the global economy sooner. Joseph, I disagree. The auditors wouldn't even list going concern at all. It's normally, I've interviewed Francine McKenna about this. She talked about this on a podcast last year, and they don't like issuing going concerns at all. So for them to issue a going concern, it means the company's basically done for. And that's why you had the stock, let me look up the last month. That's why you had, once the going concern came out, that's why you had the stock, so there looked like there was insider trading. Someone was trading on insider information in the stock. The stock price on November 4th was $1.57 a share, and then the stock started to crash then before the official announcement came out on November 5th. So someone had the information. By the time it became public, the stock was at $1.28. Then it quickly gapped down to 83 cents. And then it rallied briefly on news of the insider purchase. Let's see how much. 120. Chesapeake's top executives bought a total of 125,000 shares recently to try to prop the stock up. Finance Freak asks, going concern for a publicly traded company typically triggers debt covenants. No, the debt covenants may already have been triggered, and that's why the going concern was issued. And they couldn't renegotiate the debt covenants, and they couldn't get the banks to be more lenient. So it's a vicious circle. It's a vicious cycle between debt covenants and going concern issuance. They're normally related. So if there's problems with debt covenants, the auditors might issue going concerns. And then if there's going concern issued by the auditors, then investors and short sellers are going to start looking more deeply into the company's financials to see if debt covenants were triggered. And if debt covenants weren't triggered, then the short sellers are going to start contacting the auditor and asking why they didn't say, the investment banks and the auditors saying why the debt covenants weren't triggered. John asks, where do I see the Permian Basin in 10 years? The majors are all projecting huge production growth over the next decade. I think over the next 10 years, the Permian will peak. So you have ExxonMobil, you have Chevron making enormous amounts of investments into the Permian. And the Permian, the production may not totally collapse there, but the Eagle Ford and the Bakken are not doing well. So the major growth engine for global oil output is the Permian, and that's it. So the Permian will peak. The production will peak. They're having to put many, many billions of capital into it. And eventually, the production will stop to grow, and it will flatten out, and then it will start to decline. All these major oil fields all start to decline eventually. It's a question of when and not if. In Mexico, Canarell, which was their super major oil field, that oil production grew for decades. I believe it was discovered in the 70s, and production grew for decades. And finally, in the last 12 months, Mexico became a net oil importer because they've been subsidizing oil for so long. And the Cantarell oil field, the production has declined massively. And then even Ghawar, which was the best and largest oil field in the world from Saudi Arabia. And Matthew Simmons had been talking for years about how the Saudis were overstating production. He's one of the few Americans allowed to see a lot of the oil fields for Aramco. And when Aramco announced they were going IPO, and they started filing some of these prospectus documents, there's some interesting stuff coming out in the prospectus documents, like Shy Girl, who's an oil trader. She's been interviewed on Macro Voices. She's been highlighting some of the IPO stuff for Saudi Aramco about how much control Saudi Arabian government and Aramco are still going to have even with the IPO. So the investors are not really going to have a lot of rights with the Saudi Aramco IPO. I wouldn't buy this is just my opinion, not financial advice. I would not buy the Saudi Aramco IPO after some of the disclosures that are coming out, and I don't trust a lot of their reserves. But the most interesting thing that came out in the prospectus that I've seen so far was the disclosure, and this was much earlier this year. It was one of the first disclosures that Ghawar is producing over 1 million barrels per day less than the Saudis have been claiming for years, and that the Saudis had to bring on a lot higher production cost oil field to offset the production drop in Ghawar. So that means Ghawar, which was the lowest cost, longest lived oil field. Ghawar's been producing, I think, for over 100 years. It's a super major oil field. And Ghawar finally, the oil production looked like it was finally sputtering out, slowing down pretty rapidly. which means it doesn't mean Saudi's running out of oil. It means that Saudi is going to have to bring on higher cost oil fields, and that means that Saudi's going to have to invest a lot more. Saudi Arabia and Aramco is going to have to invest a lot more into Capex to maintain or increase production again, and their costs are going to go up for oil production because Ghawar was producing at very, very cheap costs, and replacing wells are going to cost more. The wells that replace Ghawar are going to cost more to produce each barrel of oil. In general, the auditors talking about going concern, very, very bad. They normally do not like to mention it at all. Okay, well, that's it for this podcast and all the articles. There's a bunch of articles if you want to read more about this, about the oil market and the main stories. But the bottom line, two main stories. The largest victim so far of the shale oil and gas bust, Chesapeake Energy, very on the brink, imminent bankruptcy. Don't know if it's going to happen tomorrow, next week, a couple weeks from now, a month from now, but it's going to happen soon, barring a miracle. And then also the inventory build. And I said why the analysts are getting their inventory numbers wrong. The analysts are not looking at these shale oil producers and understanding that with the debt loads they have, that the shale producers cannot cut oil production. So the shale producers are going to be maxing oil production until they go bankrupt, even through probably bankruptcy filings, whichever chapter of 7 or 11 they decide to do for bankruptcy. So expect more inventory builds, even with the decline in oil rig count, unless you see some of these large shale, publicly traded shale oil company producers announce they're cutting production. But I would say that that's very, very unlikely that they would cut production. Now, you may see a more efficiently run company like EOG Resources cut production, but that's because they don't have as much debt. The management team there has focused on free cash flow and drastically reducing the debt on their balance sheet because they're being more efficient. Management is a lot better with protecting margins, generating free cash flow, and not over leveraging the balance sheet with debt. Okay, that's it for right now. And there's a lot more good topics coming. I have so many article ideas. I'm also almost over 200 Patreon account contributors, shockingly, already. So in the next week or two, that may already happen. So thank you very much to everyone who stepped up, $5 a month. You can read my Sandstorm Gold article, which is behind the paywall. It's like 9 pages long. A lot of good insights in there. There's another new royalty for Sandstorm Gold that could be online soon. Looks like Lundin Gold, the Fruta del Norte mine, they just announced that construction is almost done with that mine, and the power line is connected to the grid. So they're hot commissioning that mine now, and Sandstorm Gold will have another royalty online, another solid royalty, and they'll continue to grow the portfolio of diversified cash flows. And then thank you very much to my monthly PayPal account contributors. There's about a dozen of you. You're really helping me out, allowing me to grow this small business so I can focus on content like this that you really won't get on a lot of the other channels. There's very few other channels that do anything close to this, especially for free. Normally, it's like behind a paywall for Hedgeye or Real Vision. Okay, well, that's it for right now, and I hope everyone has a great week.